The year 1939 began with a sense of foreboding. The world watched nervously as Hitler's Germany grew bolder. The Great Depression, though easing, still held a grip on global economies. Then, on September 1st, 1939, Germany invaded Poland. This act of aggression shocked the world. It marked the beginning of World War II. The invasion sent shockwaves through financial markets. Investors, already anxious about the future, panicked. They knew war would bring uncertainty and disruption. The stock market, a barometer of economic confidence, reflected this fear. The US stock market, still recovering from the crash of 1929, experienced a sharp decline. The Dow Jones Industrial Average, a key market indicator, fell by over 20%. This crash, though smaller in scale than the one a decade earlier, exposed the fragility of the global economy. The world was once again on the brink. The 1939 crash did not occur in a vacuum. The world was still grappling with the aftermath of the Great Depression. The US economy, though showing signs of recovery, remained vulnerable. Unemployment was still high, and many people struggled to make ends meet. President Franklin D. Roosevelt's New Deal programs had provided some relief. These programs aimed to stimulate the economy and create jobs. However, the recovery was still fragile. The outbreak of war in Europe created new uncertainties. The war disrupted trade and created shortages. It also led to increased government spending, which fueled inflation. These factors contributed to the economic instability of the time. The stock market, sensitive to these shifts, reacted accordingly. The stock market crash of September 1939 was swift and dramatic. As news of the invasion of Poland spread, investors rushed to sell their stocks. The fear was that war would cripple the global economy. Companies would see their profits plummet and stock values would collapse. The Dow Jones Industrial Average, a measure of the stock market's overall health, plunged. It lost over 12% in a single day. This drop, while significant, was not as steep as the crash of 1929. The market stabilized somewhat in the following days, but the damage had been done. The crash of 1939 served as a stark reminder of the interconnectedness of the global economy. Events in one part of the world could have ripple effects across the globe. The outbreak of war in Europe had sent shockwaves through the US stock market, highlighting the vulnerability of the financial system. While the outbreak of World War II initially triggered a stock market crash, it ultimately led to an economic recovery in the United States. The war effort created a massive demand for goods and services. Factories ramped up production and unemployment plummeted as Americans went to work to support the war effort. The government invested heavily in the war industries, providing a much-needed boost to the economy. This surge in economic activity led to a rebound in the stock market. By 1941, the Dow Jones Industrial Average had surpassed its pre-war levels. The 1939 stock market crash, though triggered by the outbreak of war, proved to be short-lived. The war, while devastating in terms of human cost, ultimately pulled the United States out of the Great Depression. It also highlighted the resilience of the American economy and its ability to adapt to changing circumstances.